It's interesting because coming into the year, what you saw was a lot of confidence and optimism, and that was really the driver of the market's appreciation in the first half of the year. You saw that because the leadership within the market was very narrowly concentrated within those mega cap tech names. What you've seen in the second half of the year is an improvement in the underlying economic data. GDP has accelerated, industrial production numbers have accelerated, spending post-hurricane and post-hurricane spending has helped GDP certainly, and that'll probably continue into 2018. We are seeing an improvement in some of the emerging market economies, and as large cap growth investors, that certainly helps some of our multinational companies. So I think those improving underlying fundamentals have really helped the market sustain and broaden out a little bit so that you've seen better performance from a broader range of companies in the second half of the year. Certainly consumer discretionary has been a strong sector for us. And within that, of course, Amazon has been a terrific stock over the last several years because they continue to benefit and gain from that trend of folks consuming more online than they are offline. And interestingly, they're growing, but also growing profitably. And so that's been a great stock for us this year. Also, Yum China has been a good stock within the consumer discretionary space. They own the Kentucky Fried Chicken franchise in China, and that company has seen accelerating same-store sales growth in China, and the stock has reacted favorably as a result. Within technology, certainly, companies like Facebook and Microsoft have been good performers for us in the year. But to my point before, the companies like Splunk or PayPal or Red Hat, some of the smaller cap tech names, mid-cap really, tech names have performed quite well during the year and really helped our performance as well. We've been overweight energy in a year when energy has not performed well. We do see signs of that trend abating in the back half of the year. You've seen oil prices clearly rise off their bottom, and the stocks have lagged a little bit, but they're starting to catch up. So I'm optimistic about 2018 for the energy sector. The other main detractor to performance has been healthcare. We've been firm believers that innovation will generate adequate returns, and companies that have good products that address unmet healthcare needs will be able to achieve pricing. What's happened in the back half of the year is that we've had some negative clinical trials and some weaker commercial launches from some companies like Celgene, and that's been a detractor to performance. It's really left that cloud over the space, if you will. We have been thinking about adding a little bit more cyclicality to the portfolio. It does seem that the first quarter, maybe second quarter too, GDP growth seems to have a nice tailwind behind it. We are thinking about the consumer and the health of the consumer. Certainly as oil prices rise, that means gas prices rise, and that has an impact on consumer spending. So I would say the consumer health and the consumer interest in spending in 2018 is something that we're going to be keeping an eye on.